Thank you first of all. It was just great hospitality here. I came last night. I met the wonderful people. I danced with a lot of people. I don't know their names yet. My Oura ring, this is a ring that finds out all my heartbeats, is telling me that I drank too much. So I have to be easy tonight, maybe not. Anyway, so the presentation today is about, the things I've been doing the last 5 years with Kinisis Ventures. It's about valuing something that doesn't make any money yet. Intellectual property is one of them, and culture. But before that, it reminds me of the innovation we discussed today. It was this first aeroplane out of the airport with no one, no pilot. It was the first tested airplane would take off, land, and no pilot. So the passengers are sitting, they hear the announcement, and it says, "You are lucky, you're the first ones that we're in a plane, there's no pilot. This is all computers generated. You're going to take off, and we're going to land in LA in about 4.5 hours. So sit back and relax. Sit back and relax. Sit back and relax. Sit back and relax. Sit back and relax." Okay. Just a little bit of myself. Basically, I'm a Cypriot that I left in '82 to go to the States to study. All hotel management. That was the big thing back then in there. And I ended up actually doing my MBA and be more in the mathematics side of it. So 40 years later, my father used to call me if I'm done with school. And I said, another semester, send money, whatever. Anyway, so I'm there, and there I worked 30 years of banking. I was an investment banker for many years, worked for a Japanese bank. I went as high as I can in a Japanese institution, which is a general manager. And I used to head of the mergers and acquisitions, which is all private equity business. It's called a leverage buyout. So I'm like an expert discussing with private and valuations of companies. The last 4 years since I left, the bank, I told my Japanese fellow, I went to the last bow, and I said, sayonara, and I left. And I started exciting stuff. I wrote about a few books on the subject of valuation, pricing, and working with Kinisis Ventures. Andreas and Janos started the business, and we're helping innovation, new companies. So my job as the numbers guy is to tell the kid that has a new idea that his little firstborn son is ugly. Because those kids love their products. Of course, they're innovators. So we are here, we're trying to find the right investments to invest. So it's been exciting 4 years. We're trying to give back to Cyprus. So we invested about 7 companies, Cypriot companies, and they're doing very well, and we're in the midst of raising a fund now. That's what we're here, actually. So with that, we'll start with a little video. So these are the kids that we're dealing with the new startups. So we try to identify the right companies. This almost reminds me of a story of this one guy sold another guy a donkey for $500. So when he was going to deliver the donkey, they said, "I have bad news for you. The donkey actually, unfortunately died. Do you still want it?" "Well, I'll pay for it. Bring the donkey." "What are you going to do with a dead donkey?" He said, "I'll figure something out." So 2 weeks later, he finds him on the street. He says, "I'm the guy I sold you that dead donkey." "Yeah? What did you do with that dead donkey?" "Well, I didn't tell anyone it was dead. I took some selfies on the side, and I put a raffle ticket lotto ticket. $2 to win a donkey. 1,000 people actually sign up and pay for it. That's amazing. You made a business out of that donkey. Yeah. Any complaints? Yes, the winner. And I gave his $2 back. So basically, we have to identify the dead donkeys out there. And it's the most difficult thing to do. There's some donkeys that actually they end up being thoroughbreds and horses. Try to find that secretariat, that one horse, the Amazon, the Teslas of the world. And hopefully we can find that. But you're going to have to invest in many donkeys and dead donkeys that don't go anywhere. And that's how I roll. And my personal note on this, I've been doing for years, is that how do you identify what are some of the characteristics of successful startups and what do you have to do? So first of all, valuating is very highly subjective. There's not really a good way to value anything. That is always lacks the ability to be perfect. Second, there's a lot of interpretation of the data. I see many people, they always choose the data that fits them, but not the data that doesn't fit them. So interpretation of data that used for valuation might make the valuation look like your company is so good, but it's not good enough, you know? Although there is several methods, which I'm going to discuss today, of valuing a company, the valuation is both a science and art. Now, the science part is more for conversation purposes. Valuation is all conversation purposes. You can't convince anyone the value is the value. You just start discussing so you can get something out of it at least and go back. And that's what I found out. At this, all the successful startups, of course, will be a convincing storytelling. You're going to convince someone that doesn't know you that this is going to work. That's probably the most difficult thing to do. I mean, if you remember, there are three. The first startup, the first concept that you discuss, first of all, your family and your friends. There are three guys actually can do the business for you. They can fund you. The 3 Fs, they call it. Of course, your mother and your father loves you, so they're going to put money because the kid came up with something. So the friends and family, they're always there for you. And then the third F is the fool. If he's not a family friend, he's putting money with you, I guess he hasn't done much of that. So there is a lot of the leap of going to that next phase, which I'm going to discuss it later, of taking the storytelling into numbers and evaluating. That's the most difficult and challenging thing to do. Naturally, the buyer has different perspective than the seller. When we live in a market, somebody's selling a stock and somebody's buying. They're both smart, but why are you selling? Since you're not valuing, the guy's buying it. Because you have different views. We live in a world of different expectations, and the expectations actually create value. And the last one, which is the most final thought I have, as a personal note before we dive into the numbers, is that at the end of the day, you can run spreadsheets. You can do anything you want. You can be dancing and looking at things like that and try to convince someone. At the end of the day, your company is worth as somebody is willing to pay. We talked about NFTs here. NFTs is a whole new world. If somebody wants to pay for that exit sign for $10,000, that's the value of that exit sign because somebody paid for it. And that's what probably, at the end of the day, that's what the valuation is. Anyone knows this guy? No, he's not a Cypriot. This guy's name is a very famous, is Lazo Hanecek. If you Google him, I'm going to tell you. He was an early developer of crypto design. He's a code writer, an early adopter of Bitcoin. It was 2010. He was very famous in Florida. In Florida, if you go outside Miami, there's a pizza place there. And this is what this guy did. Actually, what's interesting, tomorrow is the anniversary of the so-called the Pizza Bitcoin Day, May 22nd. But this is what he did. On May 22nd, 2010, 12 years ago almost to the day, he bought 2 pizzas for 10,000 Bitcoins at the time. Because he had so many Bitcoins with crypto. It was less than 0.04 cents. It was 40%, not even a 0.1 cent. So he paid 10,000 Bitcoins for 2 pies of pizza. Someone actually gave it to me. It was $40 at the time. Of course, as you know, 12 years later, Bitcoin is 30,000 each. So those pizzas cost about $300 million, 2 pizza pies. But again, if you ask the person, because they got interviewed 100,000 times, this guy, of course, He doesn't regret anything. He didn't know. The value was nothing. Nobody cared about Bitcoin. It was a crappy idea anyway at the time. So this guy, what are you going to do with this? He had like 1 million Bitcoins, a guy. He didn't want to do with it. Just start buying pizza with it, okay? And that's what I'm saying. You don't know what the idea is until you actually, you have few believers out there. By the end of the day, you always regret yourself. I should have been there. I have done that. And that's what evaluation is. There are a lot of methods of evaluating, and I teach at Columbia those methods, method 1, 2, 3, all the way to method 7 and 8 methods. There are many methods of evaluating business. Of course, the traditional methods I'm going to discuss, if you have a cash flow, a company that makes money, it's easier to value. Of course, if you have a 10-year track record, you can continue with a trend, and it's a very easy valuation, very easy story. That's easy stuff, right? And then there's so many methods. The first 5 methods is based on market. The market tells you what the company is. Then you have the method 5, 6, 7, which you do a lot of projections. This is what I'm going to do for the next 10 years. This is what my cost is going to be. And all those determine a value what somebody's willing to pay today so it can take those cash flow in the future. Easy stuff. But when you get to a newly established companies, especially an IP, a trademark, it's a whole new thinking. It's more like going to a casino and gamble that you're going to put all your money on red on a roulette and better be red, because if it's black, you're going to lose all your money. But the investor in this case, he feels like he was going to put all his money in red, okay? But he's not going to double his money. He's going to quadruple and 10 times his money. So you would go to the casino all day long. Even though you have a chance, you're going to lose all your money. So the investor has to feel that he's going to get more, has more upside than downside. And that's where the valuation starts. And methods out there on Wall Street that does that kind of a calculation is called the option pricing method, which is basically you're betting on a stock is going to go to the moon. And if it doesn't go, you lose. But if it goes, it's very rewarding. And those are the methods that we determine. But we're not here to discuss, of course, how it works, but I will give you the rundown. There are many methods traditional for valuing a company, as I mentioned, and there are some pros and cons. The market and income method, that's they're always looking for that. We're actually valuing the 7 companies now that we are doing it. So the auditors that they're doing they always ask for what is the market telling you this business? So if you're going to do a metaverse type product, what are other metaverse companies that succeeded that I can apply some of those metrics as a benchmark to you? So that's a very good approach, because if you see some other successes, you can apply the success for this one, maybe a better product. The income approach is like actually having and we're helping them at the company, our KV, at KV, which I work, having the vision. What are you going to do with this thing? You created this box that measures the food safety or something. We have a company like that. You extract water out of the lettuce, you put it in the losing machine, in 3 minutes it tells you it has listeria. So people don't get sick before they eat the lettuce. Brilliant product. But how do we sell this? How do we get from this brilliant product actually selling it? So we have to do projections. How many customers you're going to have? Who's buying it? So it's all addressable market. What's the addressable? How big is the market that buy this thing? Maybe farmers, supermarkets. So you're working backwards to get to your projections, and that's the income method. The negative about that is all in the future. You're all relying on this expectation that a customer is going to buy your product, which is the biggest leap of faith to sell a customer, to get that first customer. Cost replacement probably is the most used, because if an investor comes in and invests now, he establishes a floor, a value. And that's probably the best approach to valuing a company. If you have the first investor coming in, then the second investor feels good that the first investor put in, and that's probably that's what we're looking for. But the yellow one here, that's the one wrote books on it, discussing it, is this so-called the casino that I mentioned. You're betting on something that you feel good. If somebody walks from that door and comes to me and says, Chris, I invested $15 2 minutes ago, and I made it $20. Is that a good return? I say, well, 33%, that's pretty good. You grow from 15 to 30, your money grew 33%. And I'm going to ask you the second question. What kind of risk you took? Well, I think I tell you the risk. I put in $15 down. Another guy I found, he put 5. We put 20 together, and we toss a coin, and I won. And then you're like an idiot, because you put 75% of the money to win 50% chance. The $5 guy is the smart guy, because even though he has 50% chance of losing his 5, he had 3 times his money on the other 50%. So those are the investor has to feel that way, and that's what the option pricing model creates, that illusion at least, or expectation that if I put money in now, I'm willing to lose it, but if it works, I'm going to make 10 times my money, 100 times my money. Okay? When they started Revolut and Venmo, that kind of business, the guy that started was $100,000. He started a business, a Revolut, if you know the story. 2 years later, it was worth $28 million because there was a system that works in the fintech. And PayPal paid $125 million within 3 years. It's one of those stories. You throw a coin, but when tails comes in, the guy put 100,000, they made it at 10 million. And those are the expectations, I guess, if you will. So how do you get that? Well, you have to find the variables, all the variables that go into this model. And those are there are 5, 6 variables that try to get the investor to feel comfortable with taking this bet. The first one, first of all, in venture capital investing, there are 3 phases before you see any money coming in as income. The first phase is this called discovery phase, the proof of concept. Somebody comes up with an idea, perfect idea. Well, that's not good enough. It doesn't do anything. It's like saying, I found oil in my backyard.
But I don't know how to take it.
Exactly. How much you think, if oil is $100 a barrel, and I can extract 10,000 barrels, you think you strike rich. How much you think is worth that oil is worth? It is wrong to say $100 times 10,000, because if it's in the ground, it's still worth 0. Is when it comes out of the ground is worth something. But taken out of the ground might be worth more than $100. So it's good to have an idea, but if it costs you more to get the idea to the next customer, the idea is not that good. So that's kind of the thing. The testing, the phase 2, is testing your idea by other independent. It's not you saying, that's great, I created this thing, is unbelievable, man. No, I want someone else to tell me it's unbelievable. Not you. I mean, every firstborn son and firstborn daughter, everyone has the most beautiful baby than anyone. And I'm looking at this baby, I don't know, it's a little ugly to me, I think. That's the product that they create, because you have to look at it the perspective. Phase 3, of course, is when you get that first customer. It is the biggest milestone for any startup. Convince one customer to use your idea, and if it works, second customer, it's easy, the third customer, and the valuations go really in a 45-degree angle, okay? We have a lot of our companies in all 3 phases. We have the brand new companies like KV, which they have a proof of concept, makes sense, they started testing. I don't know, if it work, I'm not sure. It's actual execution is important. Then we have companies in phase 3 now. They have customers, and the value went from 2 million in our calculation to 50 million in 2 years, because they grabbed some customers. That's it. Customers are key. Now, sometimes funding is not that raising money is probably the easiest thing. If you have a good idea, good timing and everything, good management, good team, and all the other stuff that comes with it, money actually is easy. It's not the money. I think the team is very important, to surround yourself with winners, surround yourself with visionaries, surround yourself with a numbers guy, lawyers, because they're expensive. Always get a lawyer as your partner. Doesn't charge you a lot of money. And business people, visionaries, marketing people, teach understanding future. And a lot of the young kids today, they don't want to give that up. I can do it on my own. I say, well, I don't want to give ownership. 100% of 0 is the same, that 10% of 0, okay? It's the same number. So you sometimes have to give up some ownership to get the team going so you can get to the phase 2, 3, and beyond. And that's basically, so it does not always take monetary. It's like the kids are always looking for money. It's not the money. Get the team going. And that's more important. And I guess it's a huge area in the US, venture capital. We are raising the fund, the challenges of the Cypriot, because Cypriots, like many other cultures, they are not used to, they invest in 3 areas basically: real estate, stocks, and maybe bonds, and they have money in the bank. But if I approach and say, we're going to do venture capital, I says, when do I get my money back? Maybe never, okay? Or maybe 3 years or 4 years if we're lucky. There's no dividends involved, so you got to convince them. It's like a casino. Do you go to play cards? Yeah, that's what we're going to do. And you can have a big win one day. So that's like the convincing area. But VC became more like an established area that you, portfolio companies, portfolio managers put some 10% allocation for that, because the reward is huge if it happens. If you get the next Amazon, the next Tesla, next Uber, those are very high rewarding bets, okay? And so in establishing, I'm going to be finishing in 10 minutes, in establishing, converting the story into numbers, there's certain questions an investor asks, and I give this to every entrepreneur to be ready to answer those questions. Because if those questions are answered satisfactory, then that's a very good start for a startup. The first question, what is the market? I mean, that's a very basic thing. What's the addressable market? And you can apply, if you know about how the bigger market is, then you say you only need 1% market share, or 0.5%. So if you have a $10 billion market and you're going to get a little percentage, that's pretty good. The second one is, what are the compare advantage? What is your thing that works? I mean, these are basic questions, but you need to be ready to be sharp in answering those questions. How much will it cost to implement, which we talked about, that big thing, and how long before a competitor comes in and steals your idea and replaces you, because there are many companies there with deeper pockets that can take your idea even further than you are. And that's especially a Cypriot company. So factoring all this, the risks too. This is all about the income and the cost. And then you say, what is the risk? And that's where the bet comes in. How much will it cost to develop the idea against yourself, or give it to someone else to do it? It's a different valuation, especially when it comes to IP. Somebody says to me, I have this patent pending, or, yeah, but it's not worth anything if you develop it. You just have a patent. But it costs money for you to develop that. If you give it to Amazon to develop it, for them it's going to be much bigger value, because they have the infrastructure, they have the money, they have the customers to buy it. So the IP depends on who actually gets the IP, and that's what we have. How long it might take to get off the ground? This is probably the most difficult thing. We discussed called the death valley. Any startup, you have to put more money down until you make your first income. And usually, traditionally, it has to take 2 years. Otherwise, you're wasting your time. This is the growing pains of a startup, to continue plugging money into the business, and they haven't got the singular customer yet. And the investor is out of the pocket, you open a deep hole, and you can come out of it. And so you have to actually build that in. When we run numbers for our potential companies, we do run the death valley. We want to see, okay, how much does it cost? You have to get it developed, $100,000 a year. We got to do this, software, rent, blah, blah, blah. You got to put all that budget for the next 2 years so you can see, and when are we going to get the first customer? 2025. Okay, is it worth that effort? So that's kind of the thing. And then, of course, you have to, any unexpected challenges that you have to build in. If you put all that, I guess we'll talk about the tossing the coin. If you put all that and you say yes, 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 then you run the numbers. There's a case study I run here, which is kind of a subscription business. We talked about the company with the opportunity, and we just we answer all those numbers. We came up with a nice little model, and we put all the IPs assumptions, how much it's going to cost, 10-year assumption, and we run some numbers, and I don't want to bore you with this stuff, but you run it through the system. It's a very easy system. It's like a probability theory system, and it puts a value of the company. This company we value, which is in the SaaS business, environmental business, is valued about 2.4 million, even though it's zero, there's no income. Probably it's going to cost us $100,000 to get this off the ground. But again, it's all about valuation. And this is probably my, so our approach, since this is more like a KV where I have this, is determine the cash needs, number one, how much it costs and how long, phase 1, 2, 3. Step 2, determine the valuation on a cost basis, a market basis. And step 3, use the tool to sensitize, because constantly you have to change it all the time. And this is my favorite chart. This is the company that we determined phase 1 about 400,000, 685, and then the first customer phase 3. So you can see the debt value. It goes down. You lose money for the next 2.5 years before it takes off. What's interesting, a VC wants 30% return minimum a year. And if he's going to get out here, and this is negative, 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 to get a 30% a year average, he has to make 60 and 80 and 100% year 4 and 5, which is kind of the interesting thing about value of business, and that's the challenging. This is one of our numbers, and this is actually one of the presentations I have for our founders. And then just a final thought before I put a survey out there. Every investor looks at 3 things before they invest. They have an expectation, very high expectation. So you have to measure the expectation. You have to measure it. Just say, it's going to do well. No, how well it's going to do. You have to quantify the risk. What is the risk when I put my money in? And the time. Those are the 3 things. If you can convince all 3, then you're a good way to get money out of it. So you can convert. You need to convert the story into numbers, as I mentioned, to get the investor ready, and then you have to factor the risks again. So let me ask by show of hands. These are the factors that startups succeed. Okay? What do you think the number 1, I'm going to be asking, and you guys raise your hand. What matters the most for a startup according to Bill Gross? Idea, management, business model, funding, and timing. Who thinks idea? Okay, 3. Number 1, by the way. All of them are good factors, by the way. But what do you think the most important factor? Idea. Anyone idea again? 3. Management team. Okay, I got a little more. Get about 15. What about business model? You got 4, 5, 6, 7, 8. Funding. That's 1. And timing. Good. Well, let me give you the answers to a survey of 1,000 startups that succeeded. What was the key? The number 1 was timing.
Sorry, guys.
Team is very important, very close second. But how many times you hear the second guy makes it, not the first guy? Because he was, they talk about metaverse now, which is the next thing that shows some traction. But it's been, I don't know, 10 years. I know Andreas knows. He's been working with, what was that? What was the?
Second Life.
Second Life, they call it. You create your own life, and you go on the internet, and you go to disco and you dance. But at home, you're like this lazy guy, that's very boring guy. But your second life, you're like the, John Travolta or something. So, but that hasn't developed, of course, because there's not much income, no need. Now it's more need now. With the cryptocurrencies, with the digital, you can create your own little country, your little place, so there's no need. So time is important. Uber is timing. COVID, if it taught us anything, is all timing. The Zoom, the stock went from IPO to $400. Of course, it's down now, but it's all timing. Team is as important. Of course, the idea is very close. Believe it or not, funding is not, it's important. It still has some 50% importance. But if you get the idea and the timing, people will invest. Because there's all money chasing out there. So. Well, thank you very much. Yes.
Life is short.
Life is short. You got to get it done.
You cannot invest in the next life.
Exactly.
You invest now and enjoy it now.
Exactly. Any questions? Okay, thanks for listening. I appreciate it.